Greetings. How's everybody? Welcome back to the continuing lecture in Principles of Finance. Today's topic is the bond valuation. Now, we know already pretty much about the bond basics because we started out this semester with return on investment. The topic was return on investment, but eventually we ended up discussing a lot about the bond. And the reason is because uh, the bond return is um, the basis of the interest rates and uh, basically the benchmark interest rate um, is determined by the bond market operation by the Federal Reserve. So we discussed the basic concepts of bond. In other words, things like um, bonds can be issued by the federal government, uh, specifically by the Treasury Department, and then by the corporations and by the municipal governments, right? So depending on who is the issuer, it's called by different names. Of course, if it is issued by the Treasury Department, it's called Treasury Securities, right? Treasury Securities, as a collective name, Treasury Securities. And the corporate bonds are called, issued by corporations. It's called corporate bonds. And also, if it is issued by the municipalities, it's called municipal bonds. And of course, also depending on uh, the maturity, right? And I told you, a bond is the name reserved for only the long-term debt instrument, right? The short-term debt instrument goes by different names depending on who is the issuer. And I told you for Treasury, right? The short-term Treasury uh, with maturity under 1 year is called Treasury bills, right? T-bills, right? There are 1 month, 3 months, 6 months, a 1 year Treasury bill. And then Treasury securities with maturity between 1 and 10 years are called Treasury notes. And then Treasury with maturity above 10 years and up to 30 years is called a Treasury bond. Okay. Um, Also, for corporate bonds, right? Corporate bond is by default a name reserved for long-term corporate debt. So uh, basically, their corporate bonds have maturity longer than 1 year, and it can be up to 30 years as well. But generally, somewhere between 1 and 10 years is most frequently used and traded. And the corporate bonds with maturity under 1 year is called commercial paper. Okay, commercial paper. And commercial paper, I also told you commercial paper is another name for promissory notes. And somewhere around the second topic, the financial statements, we discussed, the difference between in the balance sheet. We discussed the difference between the commercial paper and the promissory note. I mean, although they are, I just told you they are the same, but the way, the context in which they are used can be slightly different, right? And we discussed that at the time. And then municipal bond is basically, bonds issued by the municipality. So here, this table, this is just a screenshot of the book. You may also find it in your you will find it in your book, and depending on which edition it is, the numbers may be slightly different. But anyway, let's take a look at the first one. That's Treasury securities, and the coupon rate. First, it shows the coupon rate, 2.75%. Per year, right? So that's the interest rate per year, and the interest rate is always based on the face value of the bond. The face value of the bond is always $1,000, right? So at maturity, you will get $1,000, and until then, you will get 2.75% interest, which is also called coupon interest, annually, which is then $27.50 a year, right? Makes sense. That's 2.75% of 1,000. But of course, once again, the bonds pay interest semi-annually, right? What does that mean? The frequency frequency of compounding per year, M, is 2. So actually, each coupon payment is made every 6 months, and it will be then half of this amount, right? If it is $27.50, then half of that. So that would be like $13.75 or something like that, right? And compared to that, corporate bond, and in the first column, it's showing you the name of the issuer, CIT Group. Coupon rate comes in the second column, unlike the Treasury, right? Compared to Treasury, the coupon rate is quite high. Think about it, it's more than twice, right? Coupon rate is 7%, so that means annually $70. And that also means, semi-annually $35, because the bonds pay coupons semi-annually, right? And the municipal bonds and CIT Group, you can look it up. It's something like in insurance business or something like that. And the municipal bond was issued by New York City Municipal Water Finance Authority. So New York City government, right? And the coupon rate is 4.5%. So you might say, oh, that must be $45 a year. No, actually, it is not $45. Why? Because only the muni bond, right? Muni bond has different face value. The muni bonds have $5,000 face value, 5,000. Then 4.5% of 5,000, you can calculate that, right? I mean, if it is 5%, that would be 10% of 5,000 will be 500, right? So 5% will be 250, right? 4.5% will be slightly less than that. So anyway, that can be easily calculated. But basically, this is how the bond is quoted, right? Bond price and bond yield, and bond data, bond information is released, or how it is released in the print media. Okay, in the print media, such as newspapers, right? But you can also look up bond quote information in online. But generally, you would have to. It's not easily found on Yahoo Finance or a very common bond, common stock um, quotation, stock information sites like Yahoo Finance. You would have to go to the special site set up by the called FINRA. FINRA, right? FINRA is the acronym for Financial Institution, um, Financial Institution, and national. I will have to look up uh, the acronym. Uh, but what used to be FINRA is the sequel to what used to be called National Association of uh, 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 Stocks Securities Security Dealers Association, NASDAQ. NASDAQ, right? NASDAQ is index, but NASDAQ is National Association of Securities uh, Dealers Association, and that was quite. Um, for a long time, they went by that name, but then they changed the name to. I mean, they reorganized as FINRA. Um, and So you have to, for bond informations, you have to go to FINRA website. But uh, in the traditional print media, this is the way it is released. Now, let's take a look at the next column. So for Treasury, right, the column and the second column, because first column was coupon rate, second column is the maturity, month and year. And it says February 2013. It's not February 13th, it's month and year, right? So it's not the date, February 2013. Of course, February 2013 is past for us. That was like 7 years ago. But when this example was taken, it was about 2010, around June of 2010. So at that point, uh, 2013 was still the future. And how do I know the example was taken? I'm not the author of this book. I'm the author of the custom edition, but the original book. I'm not the author of the original book, so I didn't take this example. They took this example, right? So how do I know? I mean, they never discussed, when they wrote the book. It's not like they discussed it with me. Um, but I know I can because I can backtrack it. How you remember uh, in the time value of money, we know how to solve for n, right? You learned how to solve the equation for n. So by solving for n, I could backtrack it to June of 2010. Okay, so take my word for it. Okay, I can show you later if we have more time how it works. But the point is, we can tell this bond, but this is specifically called treasury note. Why? The N here, right? The N stands for a note. So that means it was originally issued as a treasury note, like 10-year treasury note, right? And if February 13th, 2013 is the maturity, most likely this note was issued, Treasury note was issued in 2003, and March 2003, and then end of February 2013 will make it exactly 10 years, right? Um, so that's what it means, that N, right? And uh, and if you take a look at the maturity of this corporate bond, the maturity is May of 2016, and I told you um, it was around June 2010 when these examples were taken. So at that time, they still had like 6 years left, right, on this bond. Look at the maturity. Take a look at the maturity of this municipal bond. Maturity is like, June 15th of 2037. And usually, municipal bonds have very long-term maturity. So I would say this could have been 30 years, 30-year bond, meaning then uh, it was initially issued in 2007, right? And with 30 years left maturity, right? And the time this example was taken was around June of 2010, so they still had, roughly, uh, 27 years left. Now let's move on to the price quote, right? Let's go to the corporate bond first and muni bond first. Now, the last price means the price at the last closing of the market, right? Last closing of the market. So most likely, yesterday, because think about it, when it is in the it's not online, this is on a print media like newspaper. So you cannot have the closing price of the day close at the closing of the market on the newspaper of that day, right? I mean, even the evening paper would be out already by about 4 p.m., right? And then you cannot have that information printed already uh, in the evening paper. So this would be printed in the the next day paper, right? But anyway, the don't you find it a little bit curious how the price is that low? If that is the price, that means the price is $91.73, right? But now think about it. What is the face value of the bond? Did I say the face value of the bond is $1,000? Except the municipal bond, right? Except the muni bond, everything has, $1,000 face value, right? But, and think about it. This bond has, uh, and since it was 2006, when, at time, um, at the time this example was taken, it was about 2010, with 6 years left. Meaning, in 6 years, you're going to redeem $1,000, and until then, you get $70 interest every year for the next 10 years, right? And it's selling for $71, $91. Does that make any sense? I mean, isn't it too cheap, right? Anybody would buy this bond. If this is true, I would buy this bond. I would, it's not even $100. I buy it and collect, $70 every year for 10 years. That alone is like, $700, in simple aggregation, in simple sum. And then, 10 years later, I get $1,000, which is more than 10 times, tenfold, right? So if this is the correct price, that is such a incredibly phenomenal return, right? That's like 1,000%, more than 1,000% return, right? For the 10-year holding period. And also, including the coupon payment of, $70 for 10 years, right? Every year for 10 years. So something doesn't click, right? Something's not right for the price, right? Um, yeah, this is not the dollar price, right? This is not the dollar price. Clearly, if it is dollar price, this is crazy, right? No company would receive just about $91 from you and 10 years later give you, pay out $1,000, right? So this price is actually the percentage, right? Price expressed in percentage of the face value. So what does that mean? This is 91.735% of $1,000 face value, right? So that means this bond is at the last trading, right? At the closing of the market, at the end of last market, right? At the end of closing of the last market, the price was $917.35. Okay, that kind of makes sense, right? All right, and then look at the price. Then now you understand. This is also the percentage, right? So that's 97.57% of what is the face value of the muni bond? $5,000, right? 5,000. So you can do the calculation. 5,000 times 97.57%. That would come clearly above like $4,500 at least, right? But then, if you take a look at the bid treasury, right? Treasury note, it seems to have two prices, right? It doesn't have only one. One is called bid, the other one is called ask. Bid and ask, if you have ever bought or sold something on eBay, you would understand what bid and ask is. It's the price in auction. Price is in auction, right? Bid is the price that the buyer is willing to pay, right? And ask is the price that the seller is asking for, right? The seller wants to receive. So there are two prices, of course, in an auction, right? And of course, in a bond market, it's an auction because there are a stock market as well. There are buyers, there are sellers. Sellers always want a better price than the buyers, the price that the buyer is willing to pay. Buyer wants to pay less than the buyer wants to pay as little as possible, right? So there's a difference between bid and ask. That makes sense. But then, what is this? That I told you the prices are quoted as percentage of the face value. So that must be the percentage, right? But then there is something weird about the way it is written. Okay. If it is percentage, right? How do you read that? Is that 104.25%? Huh? If it is 104.25%, why isn't it decimal point. Why do they use colon, right? That colon, that's, um, but this is the weird system that the only the Treasury uses, right, for its Treasury securities. This is actually a 1 over 32 system, right? 30 seconds system, 30 seconds. That means this is 104% and 25 over 32 of a percent, right? 104 and 25, 30 seconds, right? Oh, that is that's quite unusual. Um, but you'll get used to it. You should get used to it. It's not that difficult. Um, well, basically, here, uh, numbers after colon represent 30 seconds of 1%, right? So what do I do? Why 30 seconds? Think of it this way. Let me switch to, okay, let me switch to the whiteboard. So in the old days, right? Okay, before the development of print media, newspapers were not, that common in the 16th and 17th, 18th century, right? Printing was, even rare. I mean, although movable metal types was, invented in uh, like 1400s, 1400 something. Actually, they say Gutenberg was the first, but actually, a Korean king in 15th century, uh, um, and his, court, the scholars of his court, first. Even 100 years before Gutenberg, right, developed the movable metal type. But anyway, with the movable metal type, they could print books, but newspapers had to be printed every day, which was very rare, even until like 19th century, right? And then, but the stock market has been around since a long time ago. Even from the 16th century, they had 16th or 15th, 17th century, like 1600 something, right? Um, Amsterdam in those days was the financial center of Europe. It was like New York City at the time, and they had stock market. But think about it. In those days, um, without daily newspapers that were being circulated that efficiently and effectively throughout the country, right? There was no way of delivering newspapers. Printing out newspapers daily is already a uh, uh, almost impossible task. They may print something once a month or once a week, but um, but news, stock market news, in other words, stock market news could not travel that efficiently. It could only travel by words of mouth or by horse carriage, by messenger, horse rider, and the news is no longer a news, because when the messenger on a horse arrives to the other corner of Europe from Amsterdam, that would be like weeks old, you know. And even, think about it. They will have to record it. And all those, stocks being traded in the Amsterdam Stock Exchange, right? Um, without any print media, right? The horse messenger would have to record it in a very succinct way. And in those days, literacy was not that high. So the best way to, if you think about it, you may have um, you may have seen, let's say, if you drive a car or if you ever rented a car, you would see that if you look at the fuel gauge, right, the fuel gauge would look like this. Here it is full, right? This is empty. And this is half. And what's this? 3/4, quarter, right? So in other words, if you're looking at the fuel gauge, you get the idea. You can easily, grasp the reasoning behind the 30-second system. Now, when you split it once again, what does it become? 1/8, right? 2/8, right? Half, 7/8, right? So in other words, if you split it multiple times, for example, uh, 2 to the negative third, that's 1/8, right? If you split it one more time, it's going to be 2 to the negative fourth, which is 1 over 2 to the fourth. And that's, of course, 1 over 16. And if you split it one more time, what's it going to be? 2 to the negative fifth. That becomes a 30-second system, right? 30-second. 2 to the 1 over 2 raised to the fifth power, and then that's 1 over 30 seconds, right? Now think about it. This was, in those days, this was easier to record. I mean, when they didn't have, probably this was visually more effective. But anyway, this is I'm not saying, Federal Reserve, Treasury did it this way because it was uh, for the same reason as this, but the logic behind it is pretty much the same thing. Um, so let me switch back to so they using 30-second system, then a bit of 104 colon 25 means 104 and 25 over 32%, right? So I would, to convert it into dollar price, what I would do is I'm going to multiply it by 1,000 and 1.04, right? 1.04, 104% is 1.04, plus 25 over 32 times 0.01, right? Or to make it easier, I mean, you can do 104 plus 25/32 and multiply the whole thing by 0.001, right? And it will give you, in a single shot, what is going to be the percentage portion is, and then it will be, when it's converted into dollars, it's going to be 1,047.81. And just the same, by the same analogy, you can also calculate the ask price. It comes to 1,048. So actually it's the brokers, right, and and the dealers who bridge the gap between the two. Now, then the next column is yield. Look at the yield. I mean, there's change for the treasury, but what is common through and through? What is common through all these three types of bonds are yield. Okay. And look at and what is yield? We've been talking about this a lot. Yield is basically annualized return, right? So, and remember, I've been telling you, bond is just like the house value example, right? And in house example, remember there are two types of scenarios. Scenario one, you have only capital gains or capital loss because you're using that house as just your home. But if in scenario two, that's where you use the house as a rental property. And if you use it as a rental property, there are two types of cash flows. One is capital gains or capital loss. The other one is rental income. Now think about it. A bond is like, exactly like the house. Remember, there are zero coupon bonds, right? Zero coupon bonds are the bonds that don't pay any interest, and coupon bonds that pay interest. So think about it. Zero coupon bonds, the only way zero coupons can sell is by selling at deep discount, right? $1,000 face value, but when it sells, it will have to sell for about $500, $600, $700 at discount, because it pays no interest. Then the only way it will give you some return is by selling at discount, right? So that's just like scenario one in the house value, because you buy the house for $50,000 and the over 10 years house value goes up to 100,000. Then the only source of cash flow for you is that capital gains or appreciation in the house value, right? And if you annualize, in that example, the holding period return is 100%, but if you annualize it, right, that's the yield. And in scenario two, you have capital gains, but plus you have also rental incomes for the holding period. And if you annualize it, right, that is the yield. So in case of bond, coupon bonds are like scenario two, right? So I've been telling you that there is such a analogy, right? A parallel analogy between the two. So it shouldn't be difficult to understand what these yields mean. These yields are basically annualized returns. And look at the yield of Treasury. It's not even 1%. It's like 0.89%. But as opposed to that, at best, if you round it, 0.9%. And the corporate bond has the yield of 8.838%, almost tenfold difference, tenfold. Of course, there are other different factors. First of all, how many years are left on this bond? If you remember, right? I said, this example was taken in around June of 2010. There's about 3 years left on this, treasury, and for this corporate bond, there's about 10 years left. I mean, the longer maturity, right? Longer time left maturity will translate to more chances of cash flows, right? In other words, the coupon payments, right? You have only like 6 coupon payments left in this case, but you have like 20 coupon payments left in this case. The coupon is much better, much more handsome coupon here, right? More than twice this, right? But again, the tenfold difference is not tenfold difference is quite obvious, and difference in coupon rate is not the only factor. There is also the factor of what is the selling price now. And the selling price of this treasury was like $1,040 something, whereas the selling price of this corporate bond is $917.35. So then what do you see here? Between now and the maturity, this corporate bond will have capital gains, but whereas this treasury will have capital loss, not capital gains. Why? It is you have to pay currently 1,400 something today. 3 years later, when it is maturity, you will redeem only $1,000. So there will be capital loss. On the other hand, until then, you receive $2,750 annually for 3 years for the remaining. So it may not be exactly 3 years left, because it's February, right? And when the time this example was based was June of 2010. So you don't even have 3 years left. You had about 2 years and a half left. So all that, those factors make this difference, right? So you can tell in this case, also CIT Group is paying like this 7% coupon rate. And think about it. You understand Treasury is the safest asset in the world. And so that's why Treasury is called also the risk-free. Treasury return on the Treasury is called risk-free return. So if the risk-free guy, right, the safest guy in the bond market or the lending market, the safest borrower is paying you 2.75% a year. Nobody is safer than the Treasury. So the next safest guy, the next safest borrower will be AAA bonds. And the AAA bonds, one, need to pay much higher than this. It will pay slightly higher than this, but not much, right? And then AA, there will be AA who will pay slightly more than AAA, and there will be single A borrowers who will pay better than AA, and there will be triple B borrowers who will pay better than single A. And I don't know what is the credit rating of CIT Group today. We can just quickly look it up, but if they were paying about 7%, that means clearly this wasn't, at the time, in 2010, CIT Group's credit rating wasn't AAA, or it wasn't even double A. I would say it was probably triple B at the time. But anyway, you understand the reasoning behind this. Uh, the lower the credit rating, the higher the default risk, right? So they will have to pay higher premium or higher uh, coupon interest, right, to compensate for that, risk. So there are several factors uh, uh, that contribute to this yield differential, right? Almost tenfold yield differential. Um, Now, municipal muni bond yield is somewhere in between, right? Uh, Now, so then next question is, who would want to? Who would want to invest in Treasury? I mean, if Treasury pays this low return, which is not even 1% a year, what is the merit of the Treasury? Of course, the merit of the Treasury is that it's very safe, right? Riskless, right? Riskless asset. But then, in terms of its return, it is not very, uh, it's not very rewarding, or it's not very interesting, right? The interest paid on the Treasury is not that interesting. And think about it. And if another thing is, if the annualized return or the yield is not even 1%, and if the economy is growing at a normal rate, right? You understand, if in a growing economy, what is inevitable is what? With the normal growing economy, right? Growing at a normal pace, what is the inevitable companion to growth? It's not a welcomed companion, but it is inevitable to growing economy. What is that? You forgot already? Inflation. Isn't that right? I've been telling in topic one, the first topic, we talked a lot about the, nominal interest rate, real interest rate, and inflation, right? And I told you inflation is not necessarily a bad thing, because um, inflation is a sign of vibrant economy. If inflation is negative, that means the economy is actually shrinking. If the that means deflation, right? Economy is not growing but shrinking. And if the inflation is very weak, it still is not a good thing, because um, the economy is not thriving, right? Um, so I've been telling you, too much inflation is a bad thing, of course, but a moderate inflation is a sign of thriving, vibrant, thriving economy. Now then, think about it. And I told you the Federal Reserve's inflation target is about 2%. And I've been telling you over the last decade, the economy has never seen like 2% inflation. It was always less than 2%. So if the economy is growing at a normal growth rate, and if the inflation is the 2%, this already gives you what? If the yield is not even 1%, right? Let's say 1%. Even at 1% nominal growth rate, if inflation is 2%, then what does that mean? The real growth rate is actually negative 1, right? Negative 1%. So that means, this is, interest. I mean, the rate of return. So you put $10,000 in treasury, it nominally gives you 1% return, right? 1% return. So 1 year later, you will have, 10,000 $100 nominally. But again, with 2% inflation, it's like actually setting you back by another 1%. So although so you can uh, basically discount um, 11 $10,100 by you discount it by 1.02, and that will give you what that is in real terms, in real dollars, in real purchasing power of the dollar, right? So the downside is quite clear. Downside of this low yield is very clear. I mean, the upside of Treasury is safety, but the downside is that um, uh, you might not even cover for inflation, right? You may not even. So Treasury came up with a new idea called TIPS, Treasury Inflation Protected Securities. Okay, why? Because Treasury's return is so low, right? They are providing an instrument that will protect you from inflation, that will protect the return from the uh, treasury, right? They will provide the return protection on the return, uh, protection against the inflation. So um, tips adjust par value $1,000 for inflation measured by CPI, Consumer Price Index, right? Now, you know that there are largely three measures of inflation. One is CPI, Consumer Price Index. The other one is PPI, Producer Price Index. And then uh, inflation deflator, GDP deflator, right? And these days, they also use quite frequently Personal Consumption Expenditure Index, PCE, or what they also call core CPI. But this is not macro class, macroeconomics class. We've already talked a lot about macroeconomics. So those minor details, we'll leave it for the macro class, macroeconomics class. Uh, but so we'll focus on broad inflation index called CPI, Consumer Price Index. So they adjust par value by inflation measured by CPI, and the par value is adjusted. So it changes over time, right? Every year they will adjust the par value. Par value will adjust and change over time. So the interest payments, coupon payment will also change. At terminal time, uppercase T, meaning terminal time or maturity, investors receive inflation adjusted par value. Yeah. At maturity, you're not just getting the par value of 1,000, but you will get inflation adjusted par value, so it will be more than $1,000. Okay. So consider, so you're getting, the coupon interest payments are adjusted, and the par value is also adjusted. Consider a 10-year TIPS issued on January of 2007, paying 2 3/8% coupon. So January 2007. The exact date doesn't really matter. Ignore that. What's important is January 2007. And CPI was 201.66. CPI, Consumer Price Index, in January of 2007 was 201. What does that mean? If the index number is 201, you might wonder what would be, does it start from 200? Does it start from 100? Of course, it starts from 100. Index numbers start from 100 or 1,000, or not, it's like, percentage. So 100 is the base year, always the price level of price index of the base year is 100. So what was the base year? What is the base year? 1997, right? It says TIPS is indexed to inflation in 1997. Actually, traditionally, the base year was 1984. But 1984 was already, like 40 years ago, right? It was like 40 years ago. So, but 1987, for a very long horizon research, right? Time series, very long horizon time series research. They still use 1984 as the, it's actually 82 through 84 period. They use it as the base year. But for generally more recent, macroeconomic data or macroeconomic phenomenon, they use 97 as the base year. And what happened in 97? There was a historic financial crisis also in 97, called Black Friday, or something like. There was financial market crash started by long-term capital market, which was the name of the asset management company, right? Which defaulted, which like Lehman Brothers. I was like, and then think about it. 97 it happened, 2007 it happened. And then since 2007, actually 2008 was the financial crisis, but subprime mortgage crisis that brought about the financial crisis of 2008 actually occurred in September of 2007. And almost 12, 13 years later, another crisis. But anyway, so if 97 CPI of 97 was 100, right? And then CPI of 2007 is 201 over about 10-year period. What does that mean? The inflation grew by, right, about 100%, right? From 100 to 201, right? So simply, the growth rate in price level is 201 minus 100 over 100. So that comes to like, 100%. But anyway, then 3 years later, right? January of 2010, CPI was 216. So what does that mean? From 201 to 216, right? So the growth rate in inflation was like, just roughly calculated, 216 minus 200 divided by 200. That's 16 over, right, 200, which would come to something like 8%, right? It would be, it's just a rough estimate. It's not exact. The exact number would be like, 7.231%, but we'll get to that. So then, how do you make the adjustment to the par value? The par value in 2010 will be 1,000 times 216 divided by 201. And this will give you a gross inflation, because if you divide that by that, it will come to one. Just use the round number, round number, 216 divided by 200. What do you get? 1.08, right? 1.08 means 1 plus 8%. Makes sense? So if you multiply it by the exact number will be, if you divide this by this number, exact number will be 1.07231. So if you so that means the exact inflation between these three over 3 years is 7.231%, right? 1 plus that 7.231% will be 1.07231. Multiply that by 1,000, you get 1,072.31. Right? This is the adjusted par value, adjusted for inflation for 3 years. And then since this is the par value, the coupon interest will be 2 3/8% is actually, if you convert it into a percentage, it's going to be 2.375%. 2.375. I mean, if the par value is $1,000, it will be $23.75 a year. And semi-annually, that's going to be then what? It's going to be $11 something, or $12 something, right? But then you need to multiply that coupon rate by the adjusted par value, which is this, right? And then that will come to 25 something, right? But semi-annual, coupons are paid, interests are paid semi-annually. So you divide it by 2 and it comes to 12.73. So that's not a very difficult thing to do. This is not a very sophisticated math. This is something even, as long as you can do, addition, subtraction, multiplication, division. This is something anybody can do, right? But this is what TIPS does. TIPS, what did it just do? It compensated coupon interest payment, and par value for inflation. It made adjustment, right? So, all righty, this is what TIPS is all about. Time's up, so we're gonna be talking about the Muni Bond in the next video. Well, thank you for joining. I'll see you guys in the next class. Thank you for watching. End of video.